In this video, we break down the covered call strategy to generate consistent income on your stock holdings. The covered call is arguably the most fundamental income strategy in the options world. Structurally, it involves holding a long position of 100 shares of an underlying asset and simultaneously selling one call option against that specific stock. By selling the call, you become the writer, collecting an upfront premium which immediately lowers your effective cost basis on the shares. It is termed covered because if the stock price rises and you are assigned, you already possess the shares required to fulfill the delivery obligation. This strategy fundamentally alters the risk-reward profile of stock ownership by trading potential upside for guaranteed income. Your maximum profit is capped at the strike price plus the premium received. This means you forfeit any capital appreciation if the stock rockets past your strike. However, the premium provides a buffer against downside moves. While it doesn't eliminate risk, it reduces your break-even point, offering better protection than simply holding the stock naked. Context is crucial. The covered call is designed for neutral to moderately bullish market conditions. If you are extremely bullish, selling the call works against you by limiting your participation in a rally. Conversely, if you are bearish, the premium received is rarely sufficient to offset a significant drop in the stock price. Think of this as an income enhancement tool for stable assets, not a hedge against a market crash. Selection of the strike price and expiration relies heavily on the Greeks, specifically Delta and Theta, which we discussed in Phase 3. A common conservative approach is selling a call with a delta around 0.30, which balances premium income while leaving room for the stock to appreciate before hitting the cap. You generally target expiration cycles between 30 to 45 days to maximize the rate of theta decay, letting time work in your favor. At expiration, you face two primary outcomes. If the stock closes below the strike price, the option expires worthless. You keep the full premium and retain your shares to repeat the process, often called looping. If the stock closes above the strike, your shares will be called away at the strike price. You still make your max profit, but you lose the shares, which is why you must never write a covered call on stock you aren't willing to sell. Join us in the next episode as we explore the cash-secured put. Thanks for watching.